Good evening and welcome to the WebEx session, Designing Structures for Acquiring Indian Insurance Companies and Insurance Intermediaries. The session will be presented by my colleagues Nishchal Joshipura, Simone Reis, and Abhinav Harlalka. Please note that this session will be in listen-only mode and will last for about 60 minutes, of which first 30 to 40 minutes will be spent on panel discussion. The remaining time will be available for question and answers. Requesting all the participants to be on mute mode for the session this evening. You can post your questions in the chat window while the panel discussion is on. The moderator will queue up the questions for the speakers accordingly. Should you need any assistance during the conference call, you can use the chat option. Do note that this conference is being recorded. I now welcome our session presenters. Nishchal Joshipura, co-head of our corporate practice and specializes in advising private equity funds and MNCs for their investments and acquisitions in India. Simone Reis, leader, co-head, M&A and PE. Abhinav Harlalka, senior member, corporate practice. Over to you, Nishchal, our moderator this evening.
Thanks, Diane, and welcome to all the participants joining this webinar on designing structures for acquiring Indian insurance companies and insurance intermediaries. So the way we have divided this session is in two parts. The first part will cover structures and due diligence issues related to acquisition of insurance companies. And the second part will be with respect to the structures for acquiring insurance intermediaries and some of the restructuring that can be done given the recent change under the foreign investment rules where foreign investment of up to 49% has been increased to 100% in insurance intermediaries. But before we delve deep into the structuring and due diligence issues for these acquisitions, let me spend a couple of minutes on the history of insurance sector in India. The first two insurance companies in India were set up in 1870s. In 1955, India had almost 352 insurance companies. And in 1956, the first time the government of India decided to nationalize life insurance companies. So as a result of that, almost 245 life insurance companies got merged with Life Insurance Corporation of India. A similar thing happened in 1973, wherein 107 general insurance companies were merged with General Insurance Corporation of India and its 4 subsidiaries. Till 1990s, Life Insurance Corporation had pretty much a monopoly with respect to insuring life insurance policies. But Government of India opened up the insurance sector in 90s, and as of today, as we know, there are many private sector players in the insurance sector. And the latest tally as far as insurance sector in India is concerned is as follows. We have about 24 life insurance companies, about 25 general insurance companies, and about 6 health insurance companies. So, as I mentioned, today's webinar, we are going to split in 2 parts. First one for insurance companies and second for insurance intermediary. Insurance intermediary, as far as the insurance sector is concerned, comprise of third-party administrators, insurance brokers, web aggregators, corporate agents, surveyors, and loss assessors. So these are the types of entities which get covered under insurance intermediaries. As far as insurance companies are concerned, the way we are looking at structuring this session is to look at from the perspective of a strategic acquirer and a private equity fund acquirer. So with this, let me go to the to Simone with the first question. Simone, there has been a lot of interest which the insurance sector has generated in the last couple of years, and clearly with COVID-19 happening, this is one sector which is going to do well going forward, given the need for more health insurance policies going forward to ensure that if similar outbreak happens, people are insured. So with this development happening, and the fact that insurance sector itself is going through many opportunities with respect to acquisition and private equity funding, could you throw light on what are the structures that can be used for acquiring insurance companies, both by strategic acquirers and private equity funds?
Sure, Nishchal. So I think let's sort of discuss the different types of insurance companies. Now, insurance is a sector, or insurance company is really where the kind of company you are and the kind of investor will determine how you make the investment in the insurance company. Now, as you rightly pointed out, the FPI cap today is capped at 49%. The insurance companies are concerned, and foreign investors cannot control this entity. So a lot of the structures that we see really depend on and are really catered towards this restriction of the IRDA in terms of 49% and lack of control for foreign investors. But let's first break this down into whether this is a listed or an unlisted company. If you are a listed company versus an unlisted company, the rules that apply to you may differ. Let's stick with a unlisted company for now. And Nishchal, I know you're going to talk about listed insurance companies, but I will stick to unlisted insurance companies for now. Thereafter, you look at as to whether the investor is a private equity investor or the investor is a strategic investor. Let's first talk about private equity investors. Now, the insurance regulations with respect to private equity funds, investment by private equity funds in Indian insurance companies, defines a private equity investor or private equity fund to include an AIF. It's not the most clear definition, but in essence what it says is that any fund today that is specifically formed for investment in one or two entities is a private equity fund. So in common parlance, a pooling vehicle would be a private equity fund. If you are a private equity fund making an investment into an insurance company, again, you need to look at certain other subdivisions. Are you acquiring less than 10% or are you acquiring more than 10%? And all of these examples are investments directly into the insurance company where the shareholders or the investors and the promoters are directly investing at the insurance company level. And the reason why the 10% threshold is important is because a private equity investor assumes the role of an investor only if it is holding less than 10%. The minute it is holding more than 10%, it is classified as a promoter of the insurance company. We will discuss the difference between a promoter in a unlisted insurance company turning and the difference between a promoter in a listed company versus a promoter for the purposes of SEBI Takeover Code and SEBI ICBR regulations and all of those. The concepts may not, could differ. But in essence, in an unlisted company, any sort of private equity investor holding more than 10% is deemed to be a promoter. Now, if you are holding less than 10%, you can invest directly into the insurance company, and the private equity fund can hold securities directly in the Indian insurance company. There are certain criteria that you need to fulfill. One is of course, that you fulfill the fit and proper criteria that the IRDA has. Even if you are a private equity investor making an investment into an insurance company, you need to ensure that the minimum shareholding of the promoter and promoter group of the Indian insurance company is 50% or more. The other sort of criteria here is that the private equity investor will have to give a specific undertaking that they will not create any encumbrance or leverage over these shares. So it is a simple sort of, there are simple criteria to fulfill if you are a private equity investor holding less than 10%. Now, again, here, I think we need to sort of bifurcate between private equity investors holding less than 10% that are Indian and private equity investors that are foreign. With respect to investors holding less than 10% that are Indian investors, the total shareholding of these Indian private equity investors cannot exceed more than 25% of the paid-up share capital of the insurance company. So there are many sort of permutations and computations. This does not apply to foreign private equity investors. So if you have, various sort of funds having less than 10%, they can go up to 49%. That's how the law works with respect to investors holding less than 10%. If you are holding, or if you desire to acquire more than 10%, whether you're foreign or not, the private equity investor has to come in through an SPV. We cannot invest directly into the insurance company, and here is where the structuring can get a little bit interesting, right? So you have today an SPV that is, and as per the regulations, defined as either a company or an LLP formed to invest into this insurance company, and this has to be an SPV that really only holds this investment. The private equity investor has to hold securities in this SPV, and the SPV then becomes a shareholder in this entity. Now, the SPV and the private equity investor are deemed to be promoters for the Indian insurance company, and the main sort of concern or the main sort of obligation of this promoter, in addition to fulfilling fit and proper criteria, in addition to giving undertakings and no encumbrances, are really twofold. One is that there is a lock-in prescribed of at least of 5 years for the private equity investor investing as a promoter. You have to, your securities are locked in for the period of 5 years. And this is not just the SPV shares, but also the shares held by the investors, the private equity investor in the SPV. So both are sort of locked in for a period of 5 years. The second issue really is that there has to be an undertaking that is given to the IRDA that the promoter will ensure that the Indian insurance company is not cash strapped. So there is an obligation to subscribe to funds of the insurance company if the Indian insurance company is cash strapped. In addition to that, there are some other undertakings which include, certain governance requirements. For instance, 1/3 of the board of directors of the insurance company, if you're inviting foreign promoter shareholding, has to be at least 1/3 of the directors have to be independent directors. The minimum shareholding of the promoter group continues to be 50% or more. Directly or indirectly, if you have shareholding change at the SPV level of more than 25%, you require the prior approval of the IRDA. And these specifically are the restrictions where a private equity investor is investing as a promoter. Now we can sort of deal with what this means from a structure perspective when you have an SPV in between the entity, the target entity and yourself, especially from a liquidity perspective and an exit scenario, because of course there will be a cash trap once the SPV exits out. There could be a cash trap sitting in the SPV. So how do you sort of distribute that? And is it really tax efficient? We'll cover these issues a little in a bit. But let me sort of move on to the other set in terms of a strategic investor. If you are a strategic investor, that means you are not a private equity investor, Indian or foreign, you have the ability to acquire directly without these restrictions being applicable to you. That means that means today a strategic investor holding less than 10% in an insurance company, continues to be an investor. Anybody holding more than 10% in an insurance company will continue to be a promoter. But the criteria of the SPV does not apply to a strategic investor. Of course, the 49%, if you are foreign strategic, continues to apply. Insurance companies that want to acquire other insurance companies, there are certain limitations there, and typically the IRDA doesn't really like one insurance company acquiring another insurance company, and typically asks for such acquisitions to be a merged entity as a whole, so that there is no it's not one insurance company sort of investing into another insurance company. Now, I do know I've spoken for a while, so Nishchal, maybe let me sort of bring you in here. You've been involved in the first PE buyout of an insurance company. Now, it'll be sort of interesting for us to understand, especially from an exit perspective, how your clients sort of looked at this opportunity, and what are the practical challenges that were faced, especially in making applications to the IRDA.
No, thanks, Simone. In fact, in the last couple of years, we have been involved in number of insurance company related transactions where we have faced number of practical issues. So let me discuss a few issues which we faced on some of the transactions. So the first issue that we faced was what's the type of SP that can be used for the purpose of acquiring the insurance company by a private equity fund. So assume that a private equity fund wants to become a promoter of an insurance company. As Simone mentioned, there is a requirement for an SPV to be set up between the promoter entity, which is the private equity fund, and the insurance company. So the first question which comes up is, should it be set up as an LLP or should it be set up as a company? The problem with the company structure is, let's take a situation where there is a private equity fund which is an AIF. AIF sets up an SPV in the form of a company, and that SPV in turn acquires the insurance company. The problem with that is, from a tax perspective, assume that there is either a trade sale of insurance company that happens at a later date or the insurance company goes public. There will be a capital gains tax of 10% which will have to be paid by the SPV. And when the SPV distributes this income to the AIF, AIF being a tax pass-through entity, depending on whether the investors in the AIF are domestic or foreign, there will be further tax implications that will be there. If the investors in the AIF are also domestic investors, given the fact that in this budget the dividend distribution tax has been removed and now the dividend tax has to be paid directly by the recipient, it could become quite tax inefficient for the domestic investors in the AIF. So the next question which comes up is, how about having an LLP as an SPV? And here is what practically we faced, the challenges that we faced with registrar of companies in incorporating the LLP, because one issue with LLP from a structuring perspective is you cannot have foreign investors directly coming into the LLP, because as we know, under the foreign investment rules, an LLP is eligible to receive foreign direct investment only if it does not have any performance link condition or it does not require government approval. Now, all entities in India which are merely investing entities and not registered with RBI require prior approval of the government for any investment, which means an investing LLP will be considered as an LLP that requires government approval, and hence it won't be eligible to receive foreign investment. So the question which comes up is, then in that situation, only the domestic investors can come in the LLP. If there are foreign investors, their investment can be structured through the AIF in India, as long as the AIF is domestically owned and controlled. But the practical challenge came up when we went to registrar of companies to incorporate the LLP as an SPV for the purpose of insurance company. The application actually got rejected 2 to 3 times on the pretext that Reserve Bank of India has instructed registrar of companies not to incorporate any holding LLPs, which are just into business of investing. We had to time and again explain to them that this is something which is a requirement under PE circular of 2017, and it's not something that we want to set up at our own volition. And finally, after getting a letter from IRDA that incorporation of SPV is mandatory for the purpose of promoter, and submitting that letter to registrar of companies accepted the fact that this LLP can be incorporated as per the IRDA regulations. So this was one major challenge incorporating the LLP and the issues we faced with Register of Companies. The second challenge is on the concept of foreign control. And control definition, as we know, is the most cryptic definition across all legislations in India, whether it's Takeover Code or Companies Act. Also the same thing is under the insurance laws. So when IRDA looks at the shareholders agreement, especially in situations where there are going to be two shareholders in the company who are going to survive after the acquisition, and there is a shareholders agreement between them, IRDA wants to ensure that the insurance company is not foreign controlled. And in couple of deals that we worked on, IRDA came back with a few observations that the following reserved matters they are not comfortable with being with the foreign investor. I'll just name some of them. One is change in the internal or statutory auditor of the insurance company. Second is change in any accounting policies of the insurance company. Third is change in business plan, change in key managerial personnel. And most important of all, they don't want any reserved matter which compromises on the rights of the policy holders. So clearing of any claims by the insurance company vis-a-vis policy holder is not a reserved matter that you can have in your document, even if you are a domestic promoter. So some of these things, based on practical experience, somewhere things are getting settled now as far as IRDA's position on these issues are concerned. But this was one issue that we faced on the control side. The other issue we faced while working on a couple of deals for PE funds in the insurance sector was when we made application to IRDA for the PE fund to act as a promoter. In most of the situations, these PE funds, were newly incorporated, either as trust or as foreign entities. And that's where when we went to IRDA, interestingly, in one situation, IRDA just came back and we just submitted to IRDA that this is a new entity, and hence there are no financial statements that are available for this new entity. And based on the comfort that IRDA had from public domain, they didn't ask for any further financial statements of the parent of that entity. In one other situation where we invested in for a PE fund in one of the insurance companies, IRDA went one level above and asked for the information with respect to financial statements of the parent. And this is something which is not at IRDA's volition, but is something which is required under Annexure A of PE circular of December 2017, where there is a requirement to disclose the financial statements of the shareholder. And as I mentioned, if IRDA is not comfortable with the shareholder, it may ask for the financial statement of the parent. Other important question which always comes up is whether can the acquirer, together with couple of other funds which are managed by the same manager, can they acquire 9% each and not consider themselves as promoter, because the threshold for promoter is 10%. I think there the view from IRDA has been that they look at the common control, whether the control is with the same manager, and in that case, if the control is with the same manager, then they will club all the three funds shareholding, and it will be considered as shareholding by one group of 27%, and hence all three will be considered as promoter for the purpose of IRDA regulations. The other question which also comes up is, typically in the fund model, there are LPs who always have co-investment opportunities with the GP. Now, in certain situations, the LPs have also invested in the fund, which in turn is acquiring the insurance company, and at the same time, LP is also investing directly in. And the question which comes up is, how would IRDA treat this? I think there, a lot depends on how the fund documents are structured. But as long as it's a blind pool fund where the LP is obligated to fund if the GP decides or selects a deal, the LP's investment in the fund should not be a concern, even though the same LP is directly investing in the insurance company. and that should not be clubbed with the investment with the LPs directly making with the investment that the fund is making. So that's something which is also a question which keeps coming up when we advise our private equity clients. Another important issue which we faced on some of the deals was from a timeline perspective. IRDA usually does not proceed looking at the application actively unless all other regulatory approvals are in place and received and filed with IRDA. So if a CCI approval or a competition commission approval has been triggered as part of the transaction, then in that situation, first the CCI approval has to be obtained, and only when the CCI approval is filed with IRDA, IRDA starts looking at the application. So it's not something which is a parallel process which runs where both regulators independently work. IRDA usually looks at it only after they get comfort that all other regulators have blessed the transaction. One other important nuance is on listed insurance companies versus unlisted insurance companies. There are separate guidelines for acquisition of shares of listed insurance companies, where certain thresholds have been provided, where if 5% threshold is crossed, between 5 to 10% and about 10%, and what are the KYC requirements applied by RDA with respect to all three types of acquisition. As we all know, to listed companies, insider trading regulations apply. So in case of listed insurance companies too, it becomes important from an acquirer's perspective that information which is in the form of UPSI, is handled in a manner which is in compliance with the insider trading regulations. And as we know, if the acquisition is triggering an open offer, then anyways the board of the insurance company takes a view that sharing of UPSI is in the best interest of the company. If it does not trigger an open offer, then prior to 2 working days of the transaction happening, that UPSI has to be made public. Another interesting difference between listed insurance company and unlisted insurance company is in case of listed insurance company, the obligation is on acquirer to get IRDA's approval. In case of unlisted insurance company, the obligation is typically with the insurance company itself for change in shareholding, which is 1% a transfer of 1% stake in the insurance company, or if the transferee is acquired post transfer is holding more than 5%, then in these two situations there is a requirement to go approach IRDA for approval. Now, interestingly, what happened in one of the recent cases, which is SBI Life, and it's a case which is in public domain, so we can talk about it, is one of the shareholders, which is BNP Paribas, Cardiff, they sold 5.07% stake in the listed insurance company, which is SBI Life, to multiple purchasers on the floor of the exchange. Now, at the time when they sold, there was no filing that was made by either the insurance company or by the seller. And IRDA came down heavily on them as to why the filing was not done. The view that was given by the seller was that as per the listing guidelines for insurance companies, filing has to be done by the acquirer entity and not by the seller entity or the insurance company. But IRDA took an interesting interpretation that listing guidelines are not something which you need to read, without considering the Insurance Act provisions for transfer, and hence the seller should have taken approval from IRDA before consummating the transaction. Our view is there is some flaw in the ruling of IRDA in that case, because even in case of unlisted insurance company, typically the insurance company makes application to IRDA and not the seller. So this is one nuance which one needs to keep in mind, that when you are doing a listed insurance deal, don't just look at the listed insurance company regulation, but even the normal provisions for transfer under Insurance Act, which require the insurance company to approach IRDA for the purpose of any change in share. So broadly, these are the nuances which are there as far as the deals that we did in the last couple of years and the practical experiences that we had on that.
So, Nishchal, I think before you sort of move on, just two or three questions, right? I mean, we talked about direct listing and we talked about direct investing into an insurance company. But we've seen for all of these reasons and all of these problems, most insurance companies have a holdco entity on top to escape really the consistent IRDA monitoring, right? And you have like the MAC structure where you have the holdco that houses all the investors and is the entity that finally goes in for an IPO, and the insurance company is left untouched with 100% of the equity held by the holdco. Now, two or three things, right? One is we know that especially in insurance companies, it is really a plain vanilla equity structure, so you can't really do anything fancy with respect to convertible instruments. Even the limited instruments that you can are all subordinated instruments, which are restrictive. So, do you think that the holdco structure, in addition to just maybe staying one step away from IRDA, is there any merit to that, or does IRDA also look through? Does IRDA also look through? Correct.
Sure. So in the deals that we have done, IRDA, there is a methodology prescribed for calculating the foreign shareholding in the Indian insurance company. And the way it is calculated is if the same foreign shareholder is in the holdco and in the insurance company, then only the proportionate shareholding of the foreign shareholder in the holdco to the opco is considered for the purpose of foreign shareholding in the insurance company. And hence, number of structures which are currently existing in the market are or have been set up in the form of holdco-opco structures, wherein the foreign shareholder, the holdco level is not at the opco level, and foreign shareholder is at opco level is not at the holdco level, and thereby you actually increase the headroom for receiving foreign money without breaching the 49% foreign equity cap in the insurance company. So has been used, and in fact there have been examples of successful exit also from these structures and without any legal or tax issues. So that's something which, as I mentioned, has been tried and tested, and no concerns from IRDA till date on that. Maybe Abhinav, let me ask you the next question. Given the fact that insurance industry is a very unique industry, can you throw light on specific due diligence issues that you have encountered while representing acquirers and PE funds with respect to the insurance companies?
Sure, thanks for that. I think, as you rightly mentioned, insurance is a unique industry in a very important manner. I think the first thing that is relevant to note is that the IRDA has prescribed filing requirements for each of the insurance companies, which is similar to other regulated sectors like the NBFC. However, one interesting or unique aspect about insurance companies is that all these forms and filings, so they have different forms, NL1 to NL41, all of them have to be publicly disclosed. So, these include a large number of the details of each of the insurance companies, including details on, where the premium has been obtained, with sector, aspects like who the directors, the change in shareholding, the shareholding, promoter shareholding, etc., and other operational aspects. All of them are required to be available online itself at the website of the insurer. So from a diligence perspective, that makes things a little easier as well, because you have the information available for, say, the last 3, 4, 5 years that you honestly require to look at how the entire company has flown through a period of time. Another thing that is very critical for an insurance is the IRDA correspondence. Now, the IRDA's correspondence is slightly unique again, in the sense that not only is information exchanged by way of letters, etc., but also by way of emails. So when you look at an IRDA correspondence file, you will notice that a lot of the emails from IRDA come by way of email, and they are just one-line emails rather than an official formal letter that you are more used to seeing from other regulators. And these letters are very relevant because at times these letters also include approval for certain aspects. So the IRDA correspondence is an important aspect, is probably the most important aspect of a diligence on an insurance company. Uh, Another thing that you need to look at very carefully at the time of diligence is the solvency requirement. Now, I think each insurance company is required to have a solvency margin of 1.5x. Now, that's something where we've seen a lot of insurance companies fall below that threshold. And the IRDA takes this very seriously. They have been very particular about insurance companies maintaining the solvency margin. For this, IRDA has also compelled insurance companies to raise additional funds, etc., to ensure that they are, always in compliance with the solvency requirement, so to say. And this also plays a very important role when you're finally documenting for transactions, because you don't want to give a reserve matter to any shareholder where, say, a new primary issuance of equity shares is being undertaken to ensure that you are complying with the solvency requirements of IRDA, because at the end of the day, it's a statutory non-compliance if you are not complying with it. Another aspect where an insurance company is unique or different from any other company is the number of litigations that are handled. As I think all of us can anticipate, an insurance company ends up having thousands of claims that are with it at any point of time, and it's practically impossible to go through each of the claim process and how the process is being run for each individual claim. So, an insurance company's diligence includes more on ensuring that the grievance handling or the mechanism for handling any claim is appropriate in compliance with regulations. The IRDA has a vast number of regulations on how each of the claims have to be handled. Timelines on when to respond, etc. So, I think generally, insurance company diligence is more broader in that sense when it comes to claim settlement. I think another thing to be cognizant of is, the IRDA approvals for any sort of past transfer or issuance, because that again is a very important aspect of the share capital table. And of course, one thing that you mentioned, Nishchal, was the insider trading regulations if you're dealing with a listed insurance company. And one very, very interesting or unique aspect in an insurance company is IRDA inspections. Now, IRDA conducts inspections of insurance companies from time to time. However, the practical challenge that you end up facing in such a situation is that when the IRDA completes its inspection, it gives a broad list of issues that it has identified during its inspection to the company then and there or immediately thereafter. And that list generally is a long list, and they put in all sort of discomfort that they had with the way the company was being run or any operational aspect. The IRDA then provides the company and the management to respond to those queries, to see how they are addressed by the company or what is the company's response. And then after, assimilating all the responses from the management team, the IRDA then issues a formal order. Now, before the formal order, the IRDA may reach out to the company again for further clarifications, and then the final order is issued. The concern that ends up in any diligence is this entire process is generally 12 to 18 months. So, we've done deals where, or we've evaluated deals where IRDA inspection had finished, say, in April or March, and we were evaluating the transaction in September. Now, we had the initial list of the issues that IRDA had identified and the company's responses to it, but we were unsure of how the IRDA will finally react to it. And that becomes a practical challenge quite often, because you may be in the situation where IRDA has already identified issues and will issue a notice and order, which could also include monetary penalties, but you are not sure of it so far. So that's one very, very interesting or very unique thing that we've seen in insurance transactions, which we need to be very cognizant of when we are evaluating a transaction.
We have discussed the structuring issues, the practical issues that are faced when you are representing a private equity buyer for acquiring insurance companies, and even the due diligence issues that are encountered typically at the time of diligence of insurance companies. Uh, Moving on to the insurance intermediary segment, which is the second part of the webinar. Abhinav, there have been recent changes with respect to the foreign investment caps for insurance intermediaries. Does this change anything from a structuring perspective, and is there any need to relook at the past structures which were designed to ensure that more foreign investment can be brought in spite of the fact that 49% cap was there earlier?
So I think in 2019, late 2019 itself, the foreign investment rules were amended, and from 49%, which was the earlier cap on insurance intermediaries, that was increased to 100%. Now, this was on the anvil since the last budget when the government itself notified its intention to do the same. Uh, the IRDA and the Ministry of Finance has issued, circular to extend the foreign investment rules to 100%. The IRDA has also notified certain amendments in the intermediaries regulations. Before we move on, I think it would be pertinent to note that the non-debt rules of FEMA, which basically govern investment, has not yet been amended. We anticipate or expect amendment to that very soon as well. But till that is amendment, the 100% FDI cap in India is not effective, so to say. So it's still at 49%. But considering the Ministry of Finance and the IRDA have both issued relevant circulars, we expect the non-debt rules to be amended very soon as well. Now, coming to your question, Nishchal, as you were mentioning earlier, we had a 49% threshold, and these were also restricted by the control challenge. And I think control, you were mentioning, some of the practical aspects that we ended up facing on a number of transactions. So the transactions were structured in a very different manner to ensure that foreign investors did not have controlling rights or more than 49% shareholding at the Indian insurance intermediary level. So a lot of these structures were designed as opco holdco structures, where you would have a holding company which invested in the operating company, and the foreign investment was split between the operating company and the holding company, and rights were also given accordingly. Even then, the control aspect was an important issue, and that was something that we had to be cognizant of at all times. Uh, Now, with the change that has happened, I think these issues will no longer exist. The control is no longer an issue, of course, considering 100% FDI is permitted. Having said that, I think IRDA has also been cognizant of that while it expanded the foreign investment to 100%, it put in certain bells and whistles around it. Some of them are operational to ensure that the chairman, managing director, CEO, or a principal officer are resident at all time, or at least one of them are resident. The payment to foreign promoter or its group companies or associate companies are restricted to what is absolutely necessary or what is permitted by IRDA. Any dividend repatriation is not allowed without IRDA's approval. And other aspect that they've brought in is that the technological, managerial, and other skills have to be brought in by the foreign promoter. Now, these issues are aspects that become all the more relevant in an opco holdco structure, because if you had foreign investors who are coming into the holdco, now that this permission has been granted, it needs to be seen as to how should it be interpreted, whether these aspects on, for example, the question on technological, managerial, other skills, do these need to be brought into the holdco? Do these not need to be brought in at the opco? So these are practical concerns that will become relevant now, and those are things that you need to keep in mind while you are structuring the transaction.
So this requirement which you mentioned about bringing technology and managerial expertise in the insurance intermediary, and that is covered under foreign exchange rules, FEMA rules, right? Non-debt rules. How would the private equity funds be able to satisfy this requirement? Because this is something which should more be applicable to strategic investors who are able to transfer some of this technical know-how from their local jurisdiction to India. But as far as private equity funds are concerned, they are merely financial investors. The only reason why they are acquiring insurance companies or insurance intermediaries in India is exit at some point in time at a better valuation. So, how do you see this panning out going forward? How would IRDA look at this for PE fund acquirers in insurance intermediaries?
So, initially, in a couple of deals that we were evaluating in the past, where and this was before the regulations were laid down clearly on the technological, managerial, other skills part. When we had chats with IRDA, what the IRDA wanted to understand is what is the PE investor getting onto the table. Their point was that, and even when we had a couple of chats with IRDA, IRDA's point was that, listen, it's fine for you to make an exit and, invest in the company, take control. But at the end of the day, what is the company deriving out of the entire process? And in a couple of deals in the past, and these were more to do with insurance companies, not insurance intermediaries, IRDA got a lot of comfort when the PE investors mentioned that they will be bringing in the technology that they had in other companies offshore, and these were global PE funds that we were referring to there. They would be getting in some technology from those companies or technology that they've used in those companies into the Indian companies as well. And along with that, they will also have nominee directors or management come in who are adequately qualified and are experts in insurance sector. I think that is primarily how the PE investors would be able to satisfy this requirement. But I think, as I mentioned, these are early days. We just have to wait and watch how the IRD actually plays it out.
Now, let's talk about the structuring issues that are related to intermediaries, right? Because we spoke about direct investments in insurance companies. We talked about indirect investment in insurance companies. We talked about the fact that there are issues with respect to promoters, investors. So are these problems also faced when you're investing in an insurance intermediary, or is this, limited to an insurance company? So I think it'll be good to understand from a structuring perspective what's different in structuring a investment in an insurance intermediary vis-a-vis an insurance company.
So I think, Simone, there are a few points here that are important. I think one is the OpCo versus the HoldCo structure. As we were discussing earlier, in an insurance company, the IRDA has been a lot more cognizant or vigilant in terms of the shareholder promoter and the rights that they have there along with the shareholding. In the intermediary sector, the regulations have been drafted to just cover the insurance intermediary, not the indirect shareholders. However, we've noted that it needs to be looked at on a case-to-case basis. There may be a number of aspects with respect to what sort of reserve matters do the investors have, how much of a change of shareholding is happening at the or the holding company level. There are various things that needs to be kept in mind, and a view has to be taken actually on a case-to-case basis whether an IRDA approval is required in case of a change in shareholding at an indirect level. Each insurance intermediary has different thresholds at which time the approval is required. They range from as low as 5%, I think, in case of a TPA to as high as 20% in case of a broker. And there are different thresholds that IRDA has, prescribed for each of them. So accordingly, those need to be looked at, very specifically on a case-to-case transaction basis. The other one is, of course, the fact that the new regulations that came in and the aspects that we were discussing on how exactly do the payouts or the cash out or extraction of funds take place in case of a foreign investor, especially considering the new regulations that have come in. It does not really change the situation for resident promoters, but for foreign investors, that is important. Another aspect that is very relevant is the PE guidelines that you were referring to at the beginning of the session with respect to investor/promoter investment as a PE. Those do not apply to insurance intermediaries. So that's another aspect where it becomes a lot easier for investment into insurance intermediaries by PE investors because the requirement of an SPV and the other attendant tax and regulatory challenges that we were discussing do not apply in a PE company. Other aspects, the smaller ones are like the fact that directors who need to be appointed require IRDA approval, etc. But those are common across insurance intermediary and insurance companies as such.
Yes, I'm back. Can you repeat the question, Abhinav?
So, Nishchal, we were just discussing how the insurance intermediary investment structuring is different than that of an insurance company. Nishchal, now that you're back, I think question to you and Simone, considering the recent changes that have happened and the HoldCo-OpCo deal structures that we were discussing, do you see that for investors going forward, there is a need to change the structures to remove a HoldCo at all in the first place? And what are the pros and cons of removing it and keeping a holdco structure? So Nishchal, I was just trying to understand that, considering the recent changes that have happened on the insurance intermediary side, is there a reason to change the holdco opco structures that a lot of the intermediaries today have?
Sure.
What are the pros and cons? And if yes, how exactly do we go ahead and do that?
So
So, Nishchal, let me take the
interestingly,
first half.
yeah, maybe. Why, go ahead, Simone.
Sure. So in terms of changing things around, Abhinav, you did speak about the holdco opco structure, but I think in the intermediary section, there's also been parallel structures that have emerged, where you have one company perhaps providing technology support to the intermediary, and the intermediary having sort of less foreign shareholding, and therefore a parallel structure emerges. And I think another sort of real important criteria is because a lot of the intermediaries that we're seeing really are tech-based entities that use technology as a platform to actually, carry on their business, right? Whether it's web aggregators, whether it's stockbrokers, the technology platform is really used more than just a physical from a physical business perspective. And I think therein lies an opportunity to see or to restructure, to see whether the business needs to be restructured. Because from a value capturing perspective, I think a consolidated entity is a far better idea than a non-consolidated entity. And having everything housed in one entity may be difficult because, as we all know, an insurance intermediary is only entitled to do, just like any insurance company, is only entitled to do the business that it is licensed for, and it can't really do anything else. So therefore, especially where intermediaries are heavily dependent on technology, and we did discuss before that the rules have now expanded the foreign shareholding from 49 to 50 to 100% in terms of what technology, etc., that can be brought in. I think it becomes very important, especially where technology is used as a core asset for these companies, in terms of where else investors have invested to try and bring about some efficiency in how these businesses really operate. So, especially in a parallel structure, it may be worthwhile to look at a consolidated entity, just because value capturing becomes important. Now, whether the holdco and opco should be merged, whether it should remain as a holdco opco, like I said, especially if you have other activities in the holdco, it becomes difficult to merge a holdco opco, and maybe for the reasons that we've discussed in this webinar, the holdco opco structure may continue to remain, right, unless IRDA demands otherwise. It may continue to remain. But Nishchal, sorry, go ahead in terms of how and what else needs to be done.
Sure. No, so I agree with you, Simone. I think the holdco-opco structure will remain. In fact, there have been few structures where there have been more than one holdco. I think in those type of structures, it makes more sense to merge the two holdcos so that all the shareholders, the holdco levels are in one entity, and then that holdco itself is sold as part of the sale process to the buyer. So that's something which is more suitable for both the buyer and the seller, because for the seller, if there are multiple layers of share of entities in the structure, then it adds to the capital gains tax and the dividend tax, which will have to be incurred. From a buyer perspective, the buyer won't want to acquire the entire structure in terms of two or three or maybe four entities in the structure, more because of the past life would be attached to that structure, and obviously the buyer would want a clean structure when he's acquiring the insurance intermediary. In fact, in one of the recent structures, what we did that was very innovative was we had a holdco entity that was holding shares of an insurance intermediary, and there was a foreign shareholder who had invested in the insurance intermediary prior to 31st of March 2017. when the Mauritius India treaty benefits were available for capital gains. So what we did was, in that situation, the buyer was not comfortable acquiring the holdco, and he only wanted to acquire the insurance intermediary. Now, if that was the case, the challenge that was being faced was, if the holdco sells shares of the insurance intermediary, there will be a 20% long-term capital gains tax that the holdco will have to pay. And on top of that, when the proceeds are distributed to the foreign shareholder, there will be another level of dividend tax that will have to be paid, or tax under capital reduction. So what we did in that situation was, we actually liquidated the holdco under IBC, Insolvency and Bankruptcy Code. So there is a procedure for winding up, voluntary winding up under IBC. And what we did was, uh, uh, interestingly, within a month's time, what happens under the insolvency process under IBC is, within 30-day time, if there is no claim which is received by that holding entity, and typically the holding entity anyways does not have creditors, so the question of any coming up is minimal, and hence the what we did was, after, since no claim was received, we did an in specie distribution of shares of the insurance intermediary to the foreign shareholder. Now, while that in specie distribution upon liquidation is something which, under the Indian tax laws, uh, only the shareholder is gets taxed, and not the Indian entity which gets liquidated. So we straight away eliminated one layer of tax by doing in specie distribution as part of the liquidation. And because the shareholder was a Mauritius shareholder who had acquired shares prior to 31st of March 2017, there was no capital gains tax when the in specie distribution happened. So what we achieved was, no tax at the holdco level, no tax at the foreign shareholder level, and then the sale happened, and immediately after 30 days, when the foreign shareholder directly got shares in the insurance intermediary, the sale happened, without any capital gains tax, because of the in specie distribution, there was a step up in the cost of acquisition that was inherited by the foreign shareholder, and hence there was no gain when the sale took place to the buyer of shares of the insurance intermediary. So this is one structure which we successfully implemented, and that's one major advantage of IBC, which traditionally in India people always think that liquidation is a 4-year process, 5-year process, sometimes 10 years, and hence it's not a viable solution. But interestingly, under IBC, while the liquidation process itself may take some time, but you are allowed to distribute the assets of the company, including shares held in any subsidiary, immediately after 30 days if no claim has been received by the IRP. So this is something which can also be used. I think we have about 1 minute left for the session, and let me conclude by thanking all of you for joining this webinar, and hope all of you found the content of the webinar useful. And thanks once again to all of you for joining this webinar.